All right. Good morning, everybody. These are the levels for the day from spot gamma. All right. So today, 8:30 is the biggest one. We get past that and everything else is kind of downhill from there. So we can see, anticipated impact of these different events. They're all lighter shade than 8:30. 8:30 is the big one. Crude took that rejection off of the lower structure. Looks like we might get a revisit on 64. Asia closed inside day, but with that really big indecision candle, and really not a lot either way on that. We just got nothing here, right? Just if you start to zoom out a little bit, you can see it's more of the same, a continuation. So we've got our major low set. We continue to set in peaks using, like swing high, swing low. We just set a new lower high. Expectation will be retesting the lows, breaking through, setting a new low. But they did manage to keep it inside. Europe, on the other hand, inside day breakout. Really looks like it's going to retest those lows. There's a lot of liquidity down here. You can see the defense from March 20th, that really big wick and the run back up, closing at the high of the day, and then the follow through day, really strong. So there's every expectation when we get back down there that it'll be defended again. It still just comes down to, are we going to be able to make it through there or not? They also had been, raising rates and dealing with inflation and everything else. And that's kind of the response to their market that they got. The Dow looks a lot healthier than the S&P. Lots of defense along these lows. I think if we lose the Dow, we're going to start to really see a change event across the marketplace. Consider the Dow like the safe haven index at this point. It's the flight to safety kind of thing. So we lose that, and it comes back to the old adage: if they're selling Apple, why would they buy anything else, right? So if they're selling their flight to safety, they're not going to go buy anything else. So durable goods, 830. Retail sales, 830. We do have a PMI composite flash at 945. But compared to the 830, this shouldn't be even, half as impactful. I say that, but any econ can be impactful if it catches people unawares or by surprise, or if they miss drastically off of the given anticipated numbers. So you never really want to sleep on something like that. When you know that there's an economic event that could potentially cause fireworks, and you're not yet in a trade and thinking about getting in or something like that, just look at the clock and realize that you might be stepping in front of a train. I don't tend to trade too much between 9:45 and 10 anyways, so that one doesn't really bother me that bad. I was talking with somebody last night and we were going through the options chain around the May 19. So we were looking at SPY, but when I started looking around at a lot of other names, it was really something I was starting to see across the board in a lot of places. Drastically overpriced options, even far out on the chain. During our discussions, we were sitting at around 400, 405. And this was running at, still is, $2.50 on a $5 spread, this far out of the money. That is wildly, drastically overpriced. Just insanely overpriced. You should be getting 250 at the money, not 250 this far out of the money. It's not an arbitrage situation or anything like that. It's the idea that this is very likely around the FOMC on the May event, and there's just a whole lot of volatility stuffed into this thing. It won't stick. Very likely it won't last, but it's worth kind of looking around there. Maybe even going farther out, right? If you look at something like 410, 415, and thinking about SPY, the question would be, do you really think SPY is going to go to above 415 between now and May 19? And you wouldn't even have to hold it until May 19. You would just be holding it for week, 2 weeks, however, whatever your P&L target would be. But yeah, it's not just in SPY. If you start looking around, there's waves of implied volatility through time, right? Say this is March, April, May. The volatility, like implied volatility, goes through waves in time. So, it could be low near May, come in through April and be really extreme in March. And then as you go farther along in your price structure, right, 400, 401, 402, 403, starts to fade back off, and you get too far out there and it starts to pick back up again. I know I'm kind of going nerd on you this morning, but the takeaway is start hunting around out there around that May series, that May 19, in all kinds of things: Apple, Amazon, Tesla, Google. See what you find. You might find yourself a nice, fat, juicy, plump trade to put on. Yeah. All right. Volume this morning is seriously elevated. We're above 200. And normally we get that when we've had an event. So it looks like financial contagion out of Europe is what is causing this this drop down this morning. There's still a big threat out of Bank of Japan, and I know it's not really on the radar here, but it should be. And make no mistake about it, it's not going to be done in March. March is when we get the new Bank of Japan leader. But then he's got to kind of flex a little bit, right? And show everybody, how he's going to do things. And we don't know what that looks like yet. And then they've still got the whole situation with the national wage, that negotiation is going on. There's a whole lot going on over in Japan that is concerning. So while we have this threat of contagion from bank runs starting in Europe, there is also some rumblings out of Italy. Japan's the big one. So with this elevated volume this morning, we also have a market maker move. Put those two together, you're looking at nearly a 3% move on the day, and it wouldn't even be considered outsized at that point. That'd just be a normal day. 3%. Now, from top to bottom yesterday, which I think I did a pretty good job of calling that reversal. The entire move is 2.2. So, like 2.25% right there. We could easily move that plus some, and it wouldn't even be a big move. That would just be a normal day at the office. So really kind of keep that in mind today. If we really do break down, and the fact that we've already had an inside day breakout this morning, we're trying to keep it, says that, we haven't even gotten started yet. And the elevated volume shows that traders are front and center, present and ready to unload into the weekend. They don't want to carry it. Can't say I blame them, by the way, but it's a story for another day. So as I showed on the browser, there is a trend line to the downside that's been broken. Yeah, it's too crowded. So we got a large gamma level at 39.40. It's the same one that's been there. If you look at the spot gamma for today, they actually moved it from 39.40 to 39.30. So it shifted down another 10 points. Then we've got a cog line at 39.31. And anything else is below 38.30. There's something at 38.80, but it's really close to a quarterly level. They call us a combo. All right, so as you can imagine, there's really not a whole lot down here. 38.80 for the put wall, which could give us a reversal point if we did get that far, right? We'd have to get that far and then get below it before we'd really start to see any sort of dealer gamma hedging flip. And I'm sure if you were to read the founder's notes from Spot Gamma this morning, they'll really lay out where that flip point is better than I could cover this morning. But those are your levels, right? And you got the weekly pivot point that we're still above it, just barely. When we're above it, we try to maintain a bullish posture across all of the marketplace. And when we're below it, then we're looking for shorts. And we start to consider more of a bearish stance across the market. There's still a lot of ratio charts and breadth and market charts that suggest a bullish posture. So this weakness, it doesn't really need to carry over into Monday. We don't know that it's going to yet. All of this could still be a reaction from Wednesday with a little bit of stabilization, and then Monday come ripping right back out of it again. I'm not quite sure I believe that. It's hard to lean into all those breadth charts and bullish market structure charts right now. If you're not sure what I'm talking about, take a look at stockcharts.com. David Keller, the guy is a master at talking about more of the complex ratio charts and market breadth, and yet keeping it simple enough that you don't feel like you're being talked down to. And I don't know, he does a really good job. And he would kind of lay out that argument that there's a lot of bullishness out there, even though we're not necessarily seeing it in the indexes themselves. Starting to get more of a classic B shape here. Expecting some of this to maybe clean itself out into a D shape over the coming days. We won't lose all of this volume for a long time because it's this here. But if we start building out some of this lower level, then we could end up with more of a B shape. We're at the point of control. That's our structure and support. I hate using that word, but it'll do. Below the point of control, we got an air pocket down to 3,900. There's supposed to be a cog line at 39.31, but as we can see, that's like right into the deepest of this shallow zone. Right? That didn't really make sense word wise, but if we think of this as a very shallow area, it was at the apex. There you go. Let's try that word. So I don't expect 39.31 to offer us anything, and a break below our own Globex low right now very likely gives us a straight shot to 39.01. Now, by straight shot, I don't mean a candle that looks like this. This is damage, so it's inappropriate. We don't want candles that look like that. It's unhealthy. We want a move with two-sided trading and price action that works its way down, right? 3,900 would be the goal. If we get through that, which would be, it's not the point of control, but I mean, it's really close to being the point of control. There's that much volume there. It would be an area where, we'd find some stability. I'm going to say support, but don't trust it like a handrail. Don't lean on this thing. If we break through that, then there's nothing on the volume profile underneath that. So, 3850, 3800 would be more of just structural levels, looking at tier 1 alpha, spot gamma, and using your own fibs and quant markings. So we hit that VPOC yesterday, take that off the board. We still have one below us, 3894, call it that 3900 area. It's worth noting, and if you were to actually go to a TPO chart, how much volume was sitting down here. You can see all this volume here. How much of that was a single order? I don't have an answer to that, by the way. I'm just saying, if you were to turn on a TPO chart, what we often find, and using TPO helps with this, is a very large position sitting far away at a key distance from where we opened the day before. And when price gets into that level, we get this huge spike and it catches the market, stabilizes, stops the fall for at least a little bit. Those zones or those levels are just camped there at X distance away from open all the time. And if you're using something like Bookmap or Jigsaw, it shows you those levels way out there. A normal dome is only going to give you 10 or 12, maybe 15, and you can't see that far away. A full ADR right now is 39.10. That would just cover the 1.97%. It doesn't add on 0.7. Then I can already tell you, if we're going to move 3.3%, the market will run right past that and go to 3.5. If we go to 3.79, we're going to go to 4%, right? It's going to move to a quarter percentage. So we're going to take it from the open, just run it to the downside. 3.5 puts us at 38.50. I'm kind of rounding a little bit, but 38.48 is close enough to 38.50. It's a nice round number, easy to keep track of. Now, just like yesterday, where we rallied back up hard off of those lows, if we do make a move to the downside today, make no mistake about it, dealer hedging and everything else, they can come in here and rip this thing right back up again. So, don't stick in it like it's going to last all day, because just like yesterday proved, it might not. So 38.50 to the downside is 3.5% from the open, and it is easily within our range. Okay, I'm not reaching here at all. I'm not, this isn't like clickbait exaggeration trying to scare people. Kind of lost me there, George. Let me back up a second so I can, if you're referring to this, I'm on Thinkorswim. So if, yes, this is a volume profile. It's applied to each day, as opposed to this volume profile, which is measuring 10 days all at once. Call this mapping out the 5x5. Each one of these charts is in the video description on YouTube. So if you were to, catch the replay or even just go over to my YouTube page, I put this chart link in there. You can just download it. So 3.5% move, that's 38.5 to the downside. On my website, I explain how to use them, by the way. So if this is the downside move and everybody's bearish this morning, I want to take a look at the other side, right? And this is not uncommon, that when it feels like everybody's piling into one side of the boat, I very often go to the other side of the boat. Maybe I'm a little antisocial and just don't want to be around a bunch of people, but I also don't want to follow the herd and be the last one in and the last one out. So from the open, just a full ADR would be 40.66. If we were to add the ADR with the market maker move, that'd get us around 3%. I'm going to take it to 3.5. That gets us to the cog line at 41.31, 41.32. It's good enough. Because of the market conditions that we're in, as crazy as it sounds, we can actually hit both sides. I know how nutty that sounds, but we absolutely could do that. Also, keep in mind that if we did make a move to the downside, we very likely will rebound off of that 38.50. I find it hard to imagine that we get through 38.50 to the downside unless there's something that really comes in and galvanizes this market down. And I mean, it's going to have to be some serious news. Say another bank gets taken out and that starts a bank run. That could do it. I can see that one taking us below 38.50. But it's going to have to be something pretty extreme, right? It can't just be Jamie Dimon or one of the other CEOs coming out chipping teeth. It's going to have to, have something with some meat behind it. And 41.50 for the upside move, I find it very hard to believe that even today we would get through a level like that unless something really big comes in. It doesn't have to be like the war ended with Ukraine. It doesn't have to be that big of news, but it'd have to be pretty darn good to kick us up that far. Like I talked about yesterday, this weekend, watch for a full Ginsburg. Watch for one of those Fed members to make the rounds across all the circuits in the media. Look for the message to become consistently. Right? Where they're really missing a consistent theme, a narrative, a story to carry from day to day. And they need one. They're going to start building one. Especially when Powell and Yellen were so opposite of each other and were, just completely off the mark on both sides. Did we move too far, too fast? And the answer to that is no. We are still really close to the 10-day, less than 1%. We won't start getting into extreme until we get at least -2, 2.25, 2.5. If we're less than 1% away from the 10-period moving average, then we haven't moved too far, too fast. We're not overbought or oversold. We're not due a rebound, any sort of linear regression, reversion to the mean, least squared system, nothing, none of that. In fact, right now, we're just barely below where we where we closed on Friday. So from this whole week, from Friday's close to this morning, all the running around we did, we're right back where we started. We haven't gone anywhere. Now we can hit the edge of the weekly expected move today. Easy, no problem. That'd be 38.50. Sounds familiar, right? We just talked about 38.50. It's a key level. Next week, the box is smaller, but not by very much. Why I've got it on there twice. Whatever. Simple way to gauge that is just draw a box on the week that we had, and then take that box and set it on the week that we're going to have. And you can see the new week is smaller, not much smaller, but a little bit smaller. Interestingly enough, the bottom of the box stayed in the same spot, 38.50. They actually just brought the top of the box down a little bit. Could be a little bit of that tail risk, right? It's a fair question. The question is, do I think the dollar is having any effect on the market? And It is. It's a very fair question. Um, Compared to what we had a year ago when it was nearly a perfect inverse, the dollar moved even a quarter of a percent. And man, the S&P was moving in the other direction hard and fast. So is it like that now? No, I mean that's done. We're still going to have to focus on those levels like I was talking about the other day where we kind of swag it, right? And we say, a dollar below 102, see the S&P above, 4100, something like that. The better question would be what's moving the dollar or why is the dollar moving? Because that's not always the same thing. Remember 2 years ago when China was really cracking down on all of their rich people and their rich investments, they fled out of the China market, bought a boatload of dollar and started bidding up our tech stocks. So the more the dollar went up, the more the market went up, the more tech stocks went up. I mean, it was just like rah, just big flood. That was crazy bullish for the market. And that was with a strong dollar that just kept getting stronger and stronger and stronger. So you really want to try to find articles or find a way to explain why the dollar is moving and how that's affecting the market rather than just considering the dollar went up, the dollar went down, what's it going to do to the market? We're going to continue to hold that swag line, by the way, and I need to find another word because that's not my word, and I don't really want to continue to use somebody else's little phrase. But call it. I'll even spread it out a little bit. Dollar below 101. Look for S&P to break above 4,200, kind of like that. Right. Dollar above 106. Look for SPX to break down below 3750. Those are pretty generic. I'm not even trying to tighten it up a little bit, but um, that'd be pretty close. So we got a little bit of a bounce in nat gas. Bonds continue to pop around a little bit, and I had put the warning out 6 weeks ago or so that I was exiting out of all of my long-term holds again. I had started building out the portfolio again, right? The longer term buy and hold. After my call here of this reversal back in October, started building back out into the longer term account. And I believe it was mid-January. It might have been into the early part of February where I changed my mind and went ahead and exited out of nearly everything in my long-term portfolio again. But I kept a little bit of bonds and I'm using TIP. I don't have a large position in it, but it is what I'm holding for bonds. I don't think bonds are done yet, especially if yields are going to continue to drop. So you got TNX for yields, or you can use the futures and use like slash 10Y. In the mornings, TNX isn't showing you anything, so you might have to use this. If these are going to continue to fall, it's very likely bonds are going to continue to rise, and pick your poison. ZB, ZN, ZF. You could use TLT. You can trade junk or shy. Shy is one of the largest out there. But I'm using a tip. Kind of gets you out of the rat race a little bit. Also yesterday, I went ahead and added in a couple of short options on the MES. So I'm currently holding 4,500 short call and 3,500 short put. Those don't really pay because I'm on the MES. They're about $100 a piece in profit. But we're in the middle of a zone or in the middle of a range, and I don't like to diddle in the middle. So, if you wanted to go short off the highs or long off the lows, yeah, that's great, but we're not at the highs, we're not at the lows, we're in the middle. I don't really want to start some good swing positions until we get to one side or the other. I mentioned trading the breakdown here, getting to the low, and I'm willing to do that with some size, but I'm not really willing to size up till we get on the edges of one side or the other. So to keep the money engaged, it's better than just having money in my account that I'm not using. I put it to work. Short call 4,500, short put 3,500. I think that's what I used. Maybe I used 43. I better check because I don't want to steer you guys wrong. It might be 43. I posted the picture. I think it's 43. I misspoke. Yeah, 43. May 31st expiration. 68 days to go. 3,500, 4,300. So those are the short trades that I'm carrying right now. Short call, short put. And it's just, keep the capital engaged because it's better than doing nothing. That should fit a lot of people who constantly bother me asking me for a trade. Hey, you got a good trade today? Hey, you got a good trade today? If I had a good trade today, I would point it out. It's not like I'm hoarding it with like a squirrel with a nut. We're in the middle of a zone, and until we get to the edge of the zone, there's really not a great trade. Not one I would want to size up on and put some real capital into the market. So this, at least, is something. So is HYG or TIP, Shy, TLT, right? And give you some ideas bond-wise that you could look at. And Bitcoin, after such a crazy run, BITO, we talk about, has it moved too far, too fast? I think that fits the bill. 9% away from the 10-period moving average. Now it's gone farther than that, right? Near the first of the year, this thing was like 16% past the 10-period moving average. So, compared to 9% now, that might not seem like much, but look at where the reversal generally happens. 9.25, 9.5, 10, 10 here too, 11. So, we're starting to skirt the edges of, has it gone too far to the upside, too fast? Yep. A little bit of mean reversion, knock that thing back in the other direction. Be a nice short. May 19 is where we were talking about all of that volatility. But, if you're looking here, the May 19, 74.5 implied vol is actually lower than the April 21st, which has a 79 vol average, right? So it's a little more volatility in April than you do in May. I like to get kind of aggressive. So, and at the money, this is $2 wide, 80 cents. Maybe kind of take it in a little bit more. Watch for bag holders on this one. It's got some trashy options. That didn't get any better, by the way. That didn't look good at all. The trash starts Let's see where Mark is. At around 24. And I don't even like that one. I mean, really, I'd say try to keep your spreads at 22 and less than that. Otherwise, you're getting into this trash here with no good outcome that far out. But me, I kind of like these at the monies. They're easier to defend. They'll respond faster in the move. And even though we're 28 days out, if Bitcoin was to move quickly to the downside, you could just roll these in, say roll them 14 days in, get you at around probably, because we're talking by next week, we'd be rolling at that point. So the April 6s be rolling 2 weeks in. That'd give you a risk-free, no loss trade, and you'd be able to sustain that move back down. It's down a little bit this morning in the pre-market, but not enough. I would say you want to catch an inside day breakout first for this short. So you want it to break 1683. Just keep in mind, this is a bullish Haramni. So was that just barely kind of, maybe that wick up there kind of takes it away. So financials are down 2%, Bitcoin down 2%. The KWeb constituents are down nearly 1%. This is the opposite of yesterday, right? Remember when we were in here yesterday, KWeb was up, finance was up, Bitcoin was up. We just flipped the script over. And semiconductors are down too, which is another one, right? All of these liquidity tells were strong coming into the open yesterday. And this morning, all of them are not. Which, okay, we get a little bit of that back and forth. Which is part of the reason I'm saying be careful. Looking at the S&P, we haven't gone down at all, right? We're exactly where we were Friday. So we could go into the weekend, as long as we maintain inside the box this week, we could go into the weekend, find a little bit of structure, and come out Monday ripping to the upside again. So don't get all bared up and start trying to short the market heavy yet. Nothing wrong with nibbling a little bit, putting on some shorts, just a little moderation, right? 40% of the S&P is down 0.5% this morning. And surprise, surprise, a huge part of it is finance. It's not much of a surprise, right? I was just kidding. The sectors that are down, other than finance, that really stand out are the monsters of tech. So it'd be consumer discretionary and obviously technology. So not by much yet. We want to see Apple, Amazon, Netflix, right? The big dogs. All right, so for the NASDAQ, only 25% of the NASDAQ is down a half of a percent this morning. So recognize the NASDAQ doesn't represent financials. The NASDAQ 100 does not represent financials. Half of the names that are down this morning in the S&P were financials. Here we are seeing Google and NVIDIA, a couple of those chip names too, like AMD. I didn't see MU yet, but I bet it's in here. So there it is, MU, ENPH, a couple of those China names, JD. But it's only 25% of the NASDAQ. That's not a very large weight of negative names this morning. So I just want to stress caution. Don't get all bared up yet. Facebook is up this morning, but that's probably still connected to the TikTok news, right? So we can't really lump that in with its peer group. Otherwise, we've got Google, Microsoft, and Apple. Apple being the least of those three. NVIDIA, I don't know if you guys caught it or not, but I listen to a lot of news on the AI stuff constantly. Mid-Journey and ChatGPT kind of things. And NVIDIA had this presser the other day where they really came out heavy on how their products are going to be able to assist in the AI explosion. And that's had a lot to do with how NVIDIA stock just keeps on going and going and going and going like a freaking Energizer bunny. At some point, yeah, it's going to top out and it's going to need to roll over and get some mean reversion. But the fact that it's down just a little bit today, that's not enough. So NVIDIA is an outlier and Meta is an outlier. You got to kind of separate those two and put them in their own box. Got a little bit of a capital rotation. That flight into safety that I was talking about, it's going to be a little difficult when everything that Dow wise is down, right? And if we're getting this capital rotation back into staples, where is it at? Because Amazon's down, Home Depot, Costco, Walmart. Although Walmart, is mostly flat at this point. So the idea for a really good sell-off today, the rest of these holdout, we're going to need them to get into the game. Yesterday, we had 9 sectors moving to the upside before the flip, and we dumped. And that was across the highs before the flip, right? And here we're just kind of testing the lows and waiting on news. These are 2 really big indecision candles on Apple. Now, of course, the red day was FOMC, so we can kind of be forgiving on that day. But yesterday, Another big indecision day, massive right at the top of a zone or a range, just like back here and just like right there. Now, Apple's one of those that once it gets going, a lot of times, it's like a machine. It just keeps going. But sooner or later, it does top out, right? Y'all remember that run from June, just 50 points nonstop all the way up into earnings. So the difference is if you go back and look at that run, where's the big, massive indecision candles? There are none. It's kind of my point, right? So we're barely down this morning, 158. That's not even inside day breakout yet. And yesterday's low isn't the low that you want to focus on. It's Wednesday's low, 157.83. We get a breakdown below that, and we could get, say, 156 half, which would put us down onto Tuesday's low. And that'd be a level to watch for at that point. For a flip bounce and maybe a run back in the other direction. But 156 half, we could easily get that if we can get this inside day breakout. For a swing, we don't have it yet, right? Look at the weekly. We're still holding the breakout above 157. We have to keep it. And if we keep it, we can go into next week and we can continue this move to the upside. So, it kind of goes to my argument of don't get all bared up yet. Same thing with Microsoft. Lots of indecision candles this week, sitting at the top of this cup, right? You got that really nice cup, a little bit of handle, but a lot of indecision. Now on the week, looking at this week compared to last week, we're inside week, but we're still holding above 50%. And as long as we're still holding above 50% of this candle, it's still got the opportunity to be bullish and continue this cup and handle outcome. When it comes to this cup and handle, IBD has a 5% rule that you can buy as long as it hasn't extended more than 5% above the top of the handle. So if we're calling 284 the top of the handle, we'd want to measure 5% past that. And anything in that area would be a buy zone. Now, they're a little more forgiving than me, but they're looking at, longer term swing buy hold kind of stuff. That would put you right around 298, so just shy of $300 in Microsoft. All of that would be considered a buy zone. The other rule of thumb would be once price starts to break out here, gets through this high, you really want to see an elevated volume take the average daily volume, you want to see it greater than 50% of that on that breakout. Pretty simple metrics. I know some of you are picture oriented. This is what I'm referencing. Again, I didn't make this. It's IBD, Investors Business Daily. All right, same thing with Tesla here. We've got an inside day. We have an inside day all over the place. It's not a surprise. Yesterday's low isn't really the breakdown that you want to focus on. It's Wednesday's low, which was 190.95, and we're below that, right? This morning we're at 190.10. If you split the mid on the bid and the ask, puts us at about 190, I don't know, 18. Either way, we're underneath Wednesday's low. So we've already got the breakout that I would be looking for. Now you just have to be concerned with this 188. So if you're watching Tesla for a trade today, there's no reason to jump the gun and get nervous, since we're going to be opening in this zone. You could look for a breakdown of 188 to try to close this gap down to 183. And it can do it today. Like, that'd be a one shot all the way down today. Just keep in mind, on the week, we had this nice pullback and we're working on a swing high, right? This is what I'm referencing right there, that little pullback and now a move back up. So on the weekly, it's still very bullish and really healthy. It might not look so great on the daily, but it's still digesting that stuff from Wednesday. And this is still a bullish chart. If you're looking for a long, then catching this breakover, IBD would call this an early entry, getting in on that breakout for a run back up to this 215 area. And of course, on the weekly, we're talking 316, right? Because it'd be a longer term buy and hold for a move back up into that zone. All right, massive, really skinny cup. And I don't like these really skinny cups. But it's there. We do have the weekly really big trend. And I'm pretty sure we're through it at this point. Nope, we're there. We're at the spot. So early entry breakout on this too with Google. Inside day breakout if you're looking for the day trade. It is down this morning slightly, but Wednesday's low, 103.42, is what you would want to focus on. And really 50% of 321. Let me just set this down here for a second. Let's measure this. We get 50%. That's 103.16. So Google break down below 103.16, be a nice short back to 101, maybe 100 to be a short looking in the daily, a landing down around this $100 zone. On the weekly, it'd be back to $97. But again, on the weekly, look how bullish this is. So, if you're going to go short, it's a short duration short until we know more. How we open next week is going to tell us a whole lot about this run this week. We're going to be looking for an evening star reversal in a lot of these names next week. A gap down on Monday is bullish. Okay, so keep that in mind. If we gap down on Monday, that's bullish the market. We gap up on Monday, that's going to be bearish the market. Something to consider. All right, you got your levels. We got some insight for next week, and we've talked about breakouts for today. Get some short-term trades. You shouldn't have any issues with your 0-day trades today. If you can get past lunch, this rig count shouldn't have any bearing on the afternoon session. I say that, but I mean, if they drop, 3/4 of the entire fleet, then yeah, we're going to see an impact. But it would be so rare for that to happen. When they came out with the new flex rigs back in like 2014 or something like that, when we had those new ones, and they had to shut half of them down for like a recall issue. Yeah, that affected the markets, but I don't see the rig count right now having any bearing. They haven't come out with a new fleet that would have any kind of issues like that. So also no winterization issues at this point in the year, right? If they weren't winterized, we would have seen the issues by now. No problems. So you get past the lunch crunch, and the afternoon should be free for your 0-day trades. Everybody be careful, be safe, have a good weekend. I'll see y'all next week.